Welcome to the Benson Wealth Podcast. I take complex financial and economic topics and make it accessible to the everyday listener. Hello, everyone. And as a reminder, my name is Drew Benson. I am the president and founder of Benson Wealth Management and a senior wealth advisor with Raymond James. I'm also the co-managing partner for True North Wealth Management Group, which is a platform for independent wealth advisors. I'm a former economist, and I'm currently a wealth advisor and certified financial planner. So today I had another great discussion with CPA Catherine Tindall. So Catherine's interesting because she specializes, her niche, I should say, is working with financial advisors. So if you're a financial advisor out there and you've been wanting to find a CPA that could support you with your tax planning, particularly if you're an independent advisor, Catherine could be a great fit for you. So I wanted to have her on today to talk about how she helps people. The other reason that I really like Catherine is that, and we talk about this at length, so if you're not a financial advisor and you're not looking to do tax planning, I still think you'll find this a fascinating discussion, because for a lot of folks that have worked with CPAs, I think one of the disadvantages of the field is that we haven't seen a ton of advancement in terms of advice. A lot of CPAs just sort of file your taxes and move on. What I like about Catherine is that she has a whole process of actually helping her clients not just understand their tax liability, but actually modeling out scenarios to figure out if they should spend more money to hire someone. She'll actually can give you advice on, should you hire another advisor in your practice or should you not, based on cash flow and revenue and taxes, et cetera. So very dynamic person. I've gotten to know her pretty well and actually had dinner with her and her husband and my wife, and we all hit it off great. The conversation also gets relatively philosophical today. So we talk a little bit about entrepreneurship and even a little bit about virtue and how business doesn't have to be just this nihilistic pursuit of more stuff, but that there can be something enriching and deep and soul gratifying. So love the discussion today. I really appreciate Catherine, and I hope you enjoyed the talk. Hey, Catherine, great to see you.
Yeah, thanks for having me on.
So I started to quickly and frantically press play even while you're still trying to chat with me pre-recording here, because we were having a fascinating discussion on lobsters, because today I look like a lobster because I was at a horse show with my daughter, and it's like New England weather, where if you're near a tree or a cloud, passes by and blocks the sun, the temperature drops like 30 degrees. So I did this whole routine yesterday of I had a coat on and then a vest on, and then it would warm up and I'd take the vest off and then the coat off, and then it would get cold and you'd put a vest back on. But I wasn't thinking about it. So we're like right directly in the sun most of the day, and now I look like a raccoon and a lobster. But we were talking about lobsters is the reason I brought this up, because you said that, what were you saying about lobsters, Catherine?
Well, for those people who are not New Englanders, or maybe not familiar, there's an old saying that my parents used to tell me, was that you have to wait until months that end with an R, so like September, October, November, December, to get the best lobsters, because if you do it in the summer, like when all the tourists come up, I guess the ocean's not cold enough, and so it just makes the meat like really watery and not actually very good, and the shells aren't hard enough.
Get out of here.
So you're a higher quality lobster now. That's the joke.
I love it. I'm very sweet on the inside.
Hard on the outside, sweet on the inside.
That's Drew Benson right there in a nutshell, and a lobster shell, I should say. But well, Catherine, thanks for humoring me. I'm glad that you could come on the podcast today. I'm excited to talk about what you do in tax planning. We're going to talk about taxes and how you help clients, and then also we're gonna riff for a little bit today about entrepreneurship, and maybe we'll get a little philosophical in addition to that. So, and I do want to say, my wife Becca and I thoroughly enjoyed having dinner with you and your husband Roger recently. That was a great time that we had.
Yeah, and hopefully we can keep the conversation as fun as that. It's always, I always tell people with taxes, you're in for a bit of a dry spell, but if you can make it through to the oasis of talking entrepreneurship where things are a little more fun, it'll be worth it.
Great. Okay, so you are a CPA and you have carved out a bit of a niche, particularly helping financial advisors. Talk about sort of your journey as a CPA and then how you landed on helping folks like myself with their taxes.
Yeah, so basically I'm a second generation CPA, so my parents had a tax practice when I was growing up. And in college, I thought I wanted to go into medicine, quickly realized that was a really dysfunctional industry in a number of ways. And so I ended up taking an accounting course, loved it, and have been in accounting ever since. So my whole background is basically in income tax issues, working with small businesses and individuals. I worked at several other firms before starting Dominion, which is the firm I'm with now. And part of the experience for working with the other firms was I knew I always wanted to have my own practice, to have the freedom and the control. And then working with these other firms, I realized that there were things about the model of a legacy CPA firm that I really didn't like, in just the way that the client interactions went, the way that the work was done, the way that just the whole business model of how it's basically a labor arbitrage on the staff. And so I ended up when starting this practice.
Explain that.
Yeah.
Sorry to back up. What do you mean by labor arbitrage?
Yeah, so basically what like your typical CPA firm does, and it's similar in like law firms, things like that, is that it's almost this Ponzi scheme, right? Where people come in, you come in as a junior staff person and you grind hours, and you basically, because they do an hourly billing model, they're arbitraging on the hours of your time at a billable rate, and you put in enough blood, sweat, and tears to eventually make partner in 10 plus years. And then once you get to partner level, you're on the management side, still for a lot of firms grinding out a ton of hours. But at least you're now building equity in the thing and just pushing kind of the junk work downstream to the staff. And that's kind of the game of it. And because it's that hourly billing model, you're incentivized to work as many hours as humanly possible. And so a lot of CPA firms really burn people out because you'll be doing, 80 hours a week during busy season, 60 hours a week outside of busy season. Like, it's kind of impossible if you want to have a life outside of, just doing tax work.
I had dinner with a guy one time. We were traveling, and I think we were in Scotland. This is super random, but he said, I think your industry is going to go to a billable model. And I was like, I'm out, man. Like, if we're going to a billable model, like Drew Benson will be in a fully new career at that point, because that model does lend itself to like this workaholic mindset. And I've known a lot of individuals in the CPA world that they do burn out with the big CPA firms because the amount of grind that it takes. And I have a friend who had ultimately left one of the big firms nearby. I think it was Deloitte. And they were like dumbfounded that he would ever want to leave because he was on the partnership track. But I think for him, I was like, yeah, but the lifestyle stinks. Why would I stay in this? Yeah. So.
Oh, absolutely. And I found too I had a client who came in recently where they had like a $10 million real estate portfolio. So that was a big emphasis of what we were looking at. And he was talking about, he went to a different CPA firm just to kind of check things out. And he told me kind of the scope of work of what they wanted to do. And they were adding on all of these extra things versus what I wanted to do. And I said, well, the reason why is because they're incentivized to try to create as many form filings and as many things as possible for them to spend as much time on, because that's how they bill you. Versus for my firm, the way we work is it's a subscription basis, it's a value basis. It doesn't matter. The time is just irrelevant because that's not where the value comes from. And so I'm not incentivized to try to create more work for me to do. I'm incentivized to optimize the relationship for the outcome. So it's just a very different way of operating.
So then that begs the question: how do you typically charge? Because I think a lot of people are used to more of a billable model. I know, like, we charge typically assets under management, which I love because, to your point, Catherine, and I think this is important, I'm not incentivized like you to create all this unnecessary work so that I get paid more. There is a level of conflict of interest that exists there. So I like the fact that I can just do what I think is absolutely essential and best for my clients, and I don't have to worry about, oh crap, like, how do I squeeze a little bit more juice out of this turnip now? It's a nice way to feel. But how do you raise revenue then? Or what are the revenue models that you use with clients?
Yeah, so basically it's a value approach. So because we have a very specific niche that we serve, the focus isn't, let's just do the tax return. There's a lot more pieces that go into the service model of what we do, and that I'm always trying to add more things and pay more attention to this part of your life is really frustrating and really expensive. How do we make it as quiet, as painless, and as fearless as possible for you as the owner of a firm? And so really the way that we generate revenue is by just focusing on making it a really great client experience. And then also as much as we can in ways that make sense and are viable. We deploy tax planning strategies to help reduce how much the owners are paying, but it's all in conjunction with holistically what's going on in the business.
So describe your niche? Like, who do you feel like you best support?
Yeah, basically for us, it's entrepreneurially minded financial advisors who are either, recently independent or they're, an RIA, but they basically have the goal of they want to grow. Not even necessarily that they want to grow to sell, but just that they want to grow, they want to scale, and they feel a duty towards, building up their firms, improving themselves as entrepreneurs. Like I find psychographically that connection is really important. And that they're, in the space where they're in those first couple of years of working in advisory work, but first couple of years of owning their own, practice and firm and trying to drive things forward and are starting to feel that the income tax piece is getting out of control just because their income's up.
Yeah. So what would you say are the biggest pain points that you find with wealth advisors, financial advisors, when it comes to taxes?
Writing those huge checks. Because when you're, it's when you're in professional services, and this is part of the discussion with people, is that the tax code doesn't give you, there's kind of a couple games you can play in the tax code to drive down your income tax, right? And it all revolves around being able to take deductions, synchronously with the income that you're having to recognize. And so if you're a W-2 employee, you're kind of stuck, right? The only tax planning you really have available to you is going to be, income deferrals through things like retirement planning and then like tax advantage, like brokerage accounts and things like that. Like that's kind of all you've got in your arsenal.
It's very limited.
It's really limited. But when you're a business owner or like an investor, you have basically complete control over how much income tax you pay because it's getting generated directly from the activities that you participate in and to the extent you participate them and how you run them. And so for like a real estate investor, the very common game is that, you buy properties, they're leveraged properties, you take advantage of accelerated depreciation and you game down those numbers. You run spreadsheets, figure out how much you can tolerate for leverage, and then you just go for it. For professional services, it's harder, right? Because we're not buying a long-term asset that we can now accelerate depreciation and control over. In professional services,
it's intangible.
The main asset's intangible. It's customer lists. It's the acumen you've built up in your employees. It's your reputation. It's your brand. And so that's not something you can depreciate. And so then the game becomes, okay, well, if I'm trying to grow, I'm going to have a certain amount of activity that's happening in the business that's just normal operations kicking off a certain amount of profit. And then that's going to leave me leftover profit within the business of, okay, how can I invest this into something that's going to be deductible in this year and sustainable for what the cash flow needs of the business are, so I don't starve the business of cash, but don't have a huge profit hanging out at the end of the year that I'm now going to get, at that midnight of 12/31, Cinderella's carriage turns into a pumpkin, everything goes through that tax funnel, and you're stuck with a big profit that you're having to pay a lot of income tax on. So part of the conversation is just, well, if you're trying to grow and trying to drive towards things, there has to be a game plan around, okay, when are you going to deploy the next couple of hires? When are you actually going to start to get a cash return on those investments and those new hires? Because can you afford to have somebody who's going to be fairly non-productive for 4 months? Yes or no? Depends on where you are in the business, how well capitalized you are. But it's all a game. Like you have control over when the carriage turns into the pumpkin, when those profits are running through that tax funnel at the end, right at the end of the year. So you have control over that. And so it's gaming that interaction because you can take out a line of credit and you can spend money and get deductions for that. You can hire people. There's other ways you can do it. And it has to be the game of the reducing the taxes, but also the game of, which is the heels of the game of, well, how are you building this business? because that's really the target thing. Like, we don't do things just to save taxes. You're doing things to build your business, but can we do it in a tax advantaged way?
I wish we had talked when I had made a couple of hires, and I'm very, I'm talking about this publicly, so they might listen to this. I'm very happy with 2 recent hires, and they're both doing great. But there's a lot of anxiety when you're making decisions on the finances, right? Because now you're the boss. Now you're the one who has to pay all the bills. You've got to make sure that you can cover payroll, and there's an investment piece. But there's also, to your point, there's the tax savings. So it might be a great idea or opportunity to go ahead and hire someone because you could mitigate your taxes. It would have been nice to kind of run those numbers, though. And so I think what I like about what you're describing, and I'm gonna label you today. I would say you're almost acting as a fractional CFO in a way, if you know what I mean. Right. Like if I had a CFO at my business, I'd be able to go to the CFO and say, "Hey, this is what we're thinking for staffing. Could you run this for us? And then let us know if this financially makes sense." You're doing that type of work for business owners, which is a value add. And to be frank, Catherine, it's a value add I rarely see with CPAs. Usually the way the typical CPA works, and this is, I commend you for this, is like, we're going to do your taxes, and then I'll find a few things for you to do to lower your bill. Like, hey, go buy a new truck this year because we can depreciate the truck and write it off. You see what I'm saying? You seem like you're getting into much greater detail in terms of providing deeper advice for the individual, for the business, so that they can make smart decisions.
Yeah, and it's just a different emphasis because, like with that, buy a truck, right? That piece of, I hear that advice all the time, and it drives me nuts because a truck is not an investment. It is not producing a return in your business.
Especially in my business. I'm
not a landscaper. Right? Exactly. It's different if you're like a landscaper or whatever, but if you're in professional services, like the amount of time it's like, well, go buy the truck, you can finance it, and then you get the write-off. It's like, okay, great. So now I'm pushing this tax liability into the next year because I'll be now paying the cash out in the next year on the payments on this truck, but now I'm going to be having to eat the tax on that money because I bought it for this year. And then instead of it being something like a hire, like a strategic hire of somebody, where, okay, yeah, it's an investment. They should, depending on where you are in like the theory of constraints bottleneck in your business of like where that person's actually going to be impactful and producing a good return on that investment and that wage, the labor that you bring in. The truck's just not going to produce it. It's just going to produce more expenses because now you're going to have to pay for all these other things with it. And from A to V, it's like, all right, well, you might as well have just bought I did the numbers on this actual issue recently where I said, okay, pretend you buy like a mid-range SUV where it's the over 6,000 pounds. So you get to take it. You're not getting hit with the luxury SUV limits. You get the roughly best benefit from it. Mid-range one, it was like 100,000, something like that. And then you take like the car I bought, which was a Mazda CX-9. I got it really like nice little, SUV. I think I paid $20,000 for it. It had 12,000 miles on it. And I took the difference between those two and the after-tax savings and said, if you just put this into a brokerage account and you do this cycle every 5 years, how much money will it be at the end? And it ended up being like astronomical, the amount of savings. Like it was, multi 6 figures, the amount of savings from just that one piece of advice, if you take it out of scale. And I said, well, what if you took that money in the difference instead of just socking it away to a brokerage account? Because unlike, for a financial advisor firm, unlike a normal person where they don't have a way to really improve the upside on things, right? Like they're going to participate in the market. They're kind of stuck with what the market upside is for the most part. For a business owner, especially a firm owner, you don't have limited upside. Like you could hire a employee who's a sales representative who's now going to be generating 4x, 5x of your investment in them in the second year or in the first year if they're good. It's like you don't have an upside limitation there. So why wouldn't you make that trade instead of just buying the big SUV because you want a tax write-off? That's what I would do.
I love that. And I think part of the myopia of tax planning is that we get so focused on current tax year savings. And we don't think in terms of like, sure, great, you can depreciate the truck. How about maybe just buy the truck because you want it? right? Like that's the other thing too. Like maybe you'd like a new vehicle. Go reward yourself. You did good work.
Absolutely.
Go get a truck.
Absolutely.
Right. And it doesn't have to always be this tax game, this like shell game.
Yeah.
But furthermore, back to my point, there is this myopia of just thinking about 2024, right? And how much can I save today, as opposed to, you know what? Maybe it's not the best tax decision on paper to go out and hire more employees. Yes, there's a write-off, but maybe if you invest in your business, just the longer term returns will come, many times over. It'll be a good decision. And thinking about like, I'm an advisor. So if I hire other advisors, I know, because I have two that work for me, I know there's a ramp up phase when you hire someone that they are technically a cost, and therefore there's some write-off potential there, right? So if their revenue is significantly less than what their salary is, then I've got a lot of write-offs there. Well, ultimately, I don't want a tax write-off, Catherine. Like, that's not really good business in the long run. So we always think in terms of, let's just write as much off, like, hey, don't worry about it. It's, it's like, we always joke about it. It's like, don't worry about it. It's a tax write-off. Well, I am worried about it because I don't want a tax write-off. What I want is something highly profitable and successful. And hiring an advisor, to your point, there's infinite upside, especially if you incentivize them properly with a good comp model, where they're always hustling to build business and to grow their personal book of business inside yours. Then what happens is it's just basically another revenue source within your practice. Because I think about, if I can build this out, I'll have multiple profit centers inside the broader profit center that is Benson Wealth Management. And I love that you're thinking longer run. By the way, as another quick aside, I had a client the other day. We were talking about selling one of our stocks, and we were very concerned about avoiding capital gains. I said, I got to tell you, we could be in a scenario where I did such a terrible job that we would be able to like have zero capital gains. But the bad news is you had zero actual gains in your investments. I'd rather be in a position where you've made handsome returns, and we're forced, when we need to make adjustments, to pay capital. Better to pay it than to not pay it, because that means your portfolio is probably doing well. With the caveat that there are strategies out there, by the way, if you're a listener, there's strategies out there that you can utilize to actually mitigate capital gains taxes, but that's a story for another day. But yeah, I love that. I love that you're longer term in your thinking, Catherine.
Yeah, well, you have to be, because I think at the end of the day, and we were talking about this pre-show a little bit, is that the tax tail of what's going on is attached onto the business dog, and you have to look at the whole dog. If something's wrong with the tail, it's going to impact the whole dog, and vice versa. And you really, when you're looking at a business, the core goal isn't to save taxes. Like, I see a lot of business owners, especially like even financial advisors that I've been working with recently, where they'll say things like, oh, well, I'd rather just sock it into a SEP than have to pay the taxes. And I'm like, well, I would much rather pay if you can't find a strategic deduction, pay the taxes on it, because now at least you have use of that money in an enterprise for you that doesn't have an upside limitation, and it isn't lockboxed until your retirement. But everybody has different, feelings around those pieces, and that's fine. But at least for me, my mindset is like, if you're building a professional services firm and that's the game you're in, you're doing that, you're running a successful financial services practice, it's like, that needs to be how you do all your math, in my mind, for the most part, of how you're deciding what you're going to spend your money on, what's going to be a strategic investment for you. And then just keeping in mind, like, okay, well, let's run the cash flow calculation of like, all right, well, I'm going to hire this new hire and it's going to cost me this much cash out of pocket, but at least I'm going to be getting a 30% discount because it's going to reduce my taxable income. If I take it considering the 30% discount, is it worth it for me to make that expenditure? And like vice versa too, with the, thinking of like personal expenses that are non-deductible, you have to realize like, oh, if I'm going to buy this, fancy toy thing, I have to realize I'm paying an extra tax, expense on top of that, versus if I could have kept that money in the business and allocated it into something that was a deductible business investment, I'm going to get an arbitrage on the tax side, and that, that's going to actually help me grow things. So
walk us through the way your relationships are with your existing clients. Do you, because it seems like, let me back up for a second. I think most people's experiences when they hire a CPA, and if you're a business that you hire a CPA, is you really just kind of talk when you need them. It's a billable hour arrangement, and then you just get some like on the fly tax advice. You say, what should my quarterly be this quarter, right? And then they do a little calculation, you file it and send it away. That's sort of ad hoc, and then it gets really busy. In January, we all start frantically gathering all of our documents and making sure that all of the expenses have been uploaded, and the like QuickBooks is up to date, all that good stuff. But what is your dynamic like? Like, it sounds like it might be different. Do you have a cadence of when you talk to people? How do you conduct your relationships on an ongoing basis?
Basically, I start off with like an initial assessment where I'll look at what they've got going on. And we have to start from the ground up, because I've found for quite a few advisors, they do not have good record keeping practices. And we can't do any strategic anything until we know that we've got solid financial data to model off of. So that's usually the first step, is making sure the record keeping practices are nice and tight. And then once that's in place, it goes into really figuring out what their goals are, how fast, how heavy is your foot on the gas pedal? Like, how fast are you growing, and like, where are you trying to go to? And then once we've got those pieces, it turns into, okay, how do we structure the relationship to maximize for what you're trying to do, where at the same time, my goal is to try to make it as noiseless as possible. Like, you should be busy driving business and improving things in your company, and not trying to chase after like cute little tax strategies. So like, I'm not going to recommend things that I can just tell based on, what the value of your time is going to be worth you going after in terms of, strategic tax savings. Because people will recommend stuff like the Augusta rule, which is you can do a self-rental of your house to yourself. And it's like, well, if we do the valuation of your house and you're only going to be able to take, maybe a, $500 to $1,000 deduction, for every 14 days, maybe you're only going to save yourself 14, maybe 10,000 of a write-off. And then that only translates to 3,000 of tax savings. How many hours are you going to have to put into the record keeping and just maintenance of that? And it creates noise in your life versus, more like just pay that $3,000 of tax. Don't go after the cute thing. Yeah. It's not worth it. And so like what we do for the client engagements with the advisor firms is really just, record keeping has to be on point. Second piece is you just need to know what the current income tax liability is at all times. Like, you just need to know what you're in for so that you can at least have cash saved aside. And then we do, depending on what people have going on, quarterly meetings to talk about strategic planning opportunities. Like, do they need to redo their entity structure? Very common, we have to redo their compensation to themselves out of the business. And then things like taking advantage of pass-through entity taxes, which is something a lot of states have to get around the state and local tax caps that are currently in place. And then we talk about the more strategic stuff of, okay, you've got excess cash in the business, or, for a lot of advisors who get those huge quarterly checks that create a lot of cash flow planning nightmares. Where's this check going to get parsed out to? And then who are the next, hires that you have? A lot of them, it's equity questions, because they're either buying people's practices, they're buying portions of people's practices, or, overhead sharing with other advisors who are coming in. It's a lot of that kind of behavior.
Yeah. One of the things I was curious to know is you had mentioned like what you're paying yourself out of the business. Do you find that more with just C Corps, or is there something that has to be considered with a pass-through?
Oh, yeah. So for the S Corps, that's the big issue, is making sure that your reasonable compensation is on point. We have a number of official tools that we use for that pass IRS muster, because there's been quite a few court cases of financial advisors getting taken to court by the IRS because they haven't been paying themselves enough. So that's a big part initially when people come in, is just seeing like, okay, how are you compensating yourself? Are you meeting the reasonable compensation requirements that S corporations have? can we make a reasonable argument? You do want to try to get some self-employed tax savings and then also be able to take advantage of the pass-through entity taxes. So that's usually like a piece that I recommend everybody. You have to look at it once a year. How are you compensating yourself? It can't be a number that you just pull out of a hat. It needs to be something that's got some methodology behind it.
Yeah, and I guess this would largely affect, paying Social Security and Medicare taxes as, self-employment taxes, correct?
Yeah, for the reasonable comp. Yeah, that's a lot of it. And then just some other things too, like, what you're doing for withholding and things like that. Like I have a number of advisors where we basically use their whole W-2 as federal income tax withholding. It doesn't get them all the way there, but they have to do it anyway. And they would rather just run it through that method because then if they pay it in later in the year, it gets credited a different way than estimated taxes do. So that's a technique that some people in our firm use. But
so you're not always filing quarterlies for your clients. So if there's enough income that you could withhold via W-2, then you're not necessarily having to do quarterlies. Did I hear that correctly?
Yeah, most of them. So what happens is it's optional, right? And part of it, and I think we've talked about this before. When you're making estimated tax payments, there's an element of game around it because something that I dislike is when you're in a model of business, especially if you're in a high volatility period where you might be hiring people or you might have issues in cash flow or timing or things like that. When you make an estimated payment into the federal or state governments, that money is lockboxed until you file your return. So if you put in too much, you can't get access to that cash again. And so you play this kind of, and it's really dependent on the individual situation and also the risk tolerance, et cetera. But for a lot of advisors that I work with, once we talk through, what the risks are of this, a lot of them will just bifurcate and have a separate bank account where they have as a cash accumulation account. And then maybe they put it in some pretty liquid investments or things like that so that they're getting a bit of a return on it, just to have it in case they need to deploy it. And then once we get closer to the end of the year, they'll start making in those estimated payments while we've accounted for the fact that, if you're not meeting certain thresholds, you'd be paying interest and penalties. And so that's part of the math that goes into it.
Yeah, I know that sometimes people way overpay when it comes to their quarterlies. And I mean, it's nice that you don't have to worry about paying more in, but that's money that could have been used during the course of the year to make important decisions on your business. Because, and for those of you out there that, because I think quite a few advisors listen to this, for those advisors that listen to this podcast and you're thinking about going independent, I've had conversations with some of you all out there. One of the things that you think very differently about is you really look at your personal cash situation all the time. And so it implicitly drives the decisions that you make, which you don't think about when you're an employee of a firm. It's just totally different when you're a W-2 at Merrill Lynch or Morgan Stanley or Edward Jones or any of these other firms. You don't think really like a business owner at all. When you are on your own, you start to think about your cash flow, and there's a lot more you can do from a marketing standpoint, from a staffing standpoint, in terms of running your own practice. And you need capital oftentimes to actually do those things. So if you are poor in your planning in terms of either over withholding or sending way too much to the IRS in quarterlies, or vice versa, you're not sending enough, you could be making poor decisions on your business in that moment. So you're striking a chord for me because there have been a few times where I felt like I was sort of flying blind, and it would have been nice to have a little bit more information, which is part of the reason why I wanted you on, is because I think you provide an incredibly important service to advisors. Any other thoughts you wanted to share about what you do? And then I'd like to talk a bit about entrepreneurship.
Yeah, and I guess maybe to color this with one example is I had a new advisor come in recently where he left his previous CPA firm. And this is something if you're a younger advisor and getting started out on your own, you're considering getting started out on your own, something you have to watch out for that's really common in my industry is they will generate these automated estimated payment recommendations. But if you're in an extremely volatile business, that's not going to be an accurate representation of what your actual income tax liability is because they're just basing it on prior year activity. And so if you hire a bunch of people, spend a bunch on marketing, those estimated payment vouchers they gave you are going to be totally incorrect. And so this advisor who came in, his previous firm had given him some vouchers, had told him he needed to make in some payments with extension and things like that. And he ended up overpaying in the prior year about $70,000. And it was just lockboxed over at the IRS and he couldn't get access to that capital. Yeah. And
it's a lot of money.
Like, it is a lot of money. And it's like that $70,000, like that's full, compensation for an executive assistant for the year. Do you think he could have unlocked much more than $70,000 of value out of that $70,000 had he been able to deploy that person and then freed up his time to go pursue more sales? Absolutely. So how much did that CPA firm actually cost him in making that maneuver on him? That's the difference, right?
It could have been tens of thousands, if not more, in revenue. Because if you think about it, if you hire the appropriate staff, I think what happens to advisors, Catherine, is that we get so busy with maintaining clients. You get to a certain level of growth where, you're pretty comfortable, you're making okay money, you're paying your bills, and you've got excess, and you're taking care of your clients. But then you reach the point where you do want to grow, you want to continue to expand, you want to have more staff, and hiring an additional staff person, particularly administrative assistant in particular, that frees you up to actually get back to doing some prospecting, which is something that most advisors run out of time for. And the only way to gain the time back to effectively prospect is by hiring more people that can help service your clientele so that none of the balls ever get dropped. And ideally, if you hire the right people, you actually start to create a better experience for your clients. Like, I know that we've made some changes internally. I can tell by some client feedback that they're actually happier now that I have more people working for me, because they realize, there's like multiple people sitting in the meetings now. There's multiple people, like I've got an alternative investment specialist. I'm helping to train someone to be the planning specialist. Like, you provide additional value to your clients. They're actually more happy. They're more likely to actually refer business. And I'm personally experiencing this. And then on top of it, all of a sudden it's like, I haven't had time in like 3 years to think about prospecting, like actually going out and hunting for more clients. And for the first time and I can't even remember how long, I'm actually finding a little bit of margin to go, hey, I can actually go talk to this ultra wealthy person and see if I might be a good fit, where before I really didn't even have that margin. And the reality is a lot of advisors do needless work that they shouldn't be doing. It's like, don't worry, if you're a client and you're listening to this, it's not the major stuff that matters. That's going to get pawned off to somebody else. Like, I'm still doing the bulk of the trading. I'm still sitting down with you face to face. Like, your experience with me is not changing. But there's a lot of menial tasks that I should not be doing because that's not the most productive use of my time. So I want a bright, talented person to come into my office that's eager to get into this career. They're thrilled to take that work. They're just thrilled to be in the career. So it's a positive sum game. They're winning, I'm winning, and the client is winning. And so I go on this rant, Catherine, because if they had the right partner from a tax standpoint, I think it could help them to unlock their potential of not just saving on taxes, but actually scaling a business to something that's really powerful and successful. Thoughts on that?
Oh, yeah, absolutely. Because I think at the end of the day, like you were saying, when you're first starting your practice, just the cash flow management piece is like the do or die element of what's going on. And the taxes are like the rug pull at the end of the year if you don't have an eye on that while you're operating during the year.
So true.
That first year people go into self-employment and they get hit with that self-employed tax for the first time. It's like getting, in a car accident, like they just, you don't see it coming. And so I think it's really important that you have a game plan for that and that you're working with somebody that's going to be proactive with you, because if you're in a very unsteady situation, especially like I see people where they'll be somewhere and then they're going to go and start an RIA and they're going to bring like, 50 to 100 AUM over with them. And then they change their billing model and all sorts of stuff. And so it ends up being really chaotic because it's a completely new situation. The cost structure is different because now you're having to bear a lot of your own costs instead of things going back to the custodians or back to where you were before. You're having to carry it all yourself as an RIA. And, depending on how you structure things, it's really important to keep that cash flow piece. And I think having that tax strategy follow what's going on with the cash flow management strategy and really just the bigger picture. And I think this is a great second half of the conversation, like you were mentioning, is talking about entrepreneurship, and that you really need to know where you're driving towards, because all the rest of these choices stem from that. Like, where are you going with this thing? Like, how big is it going to be? Like, why do you want it to be that big? What's the flywheel of how you're hiring people? How are you incentivizing them? How are you aligning your dreams with them? Like, those things come first. And then all of the rest of this is just in support of that.
So you're an entrepreneur. How did you get into wanting to go off on your own and starting your own CPA firm?
So back even when I was in college, I wanted to do that. Originally, my idea was just to be a lifestyle practice because I thought it afforded a really good work-life balance when you run a small firm. And then once I got more into it and started reading books and started, just self-educating in the world of entrepreneurship, which is not something that you get in most college educations, unfortunately. Like, you still take courses that are called entrepreneurship, but it's really different when you're actually out in the real business world. So once I started to experience that stuff, I was like, wow, I think, especially in my industry, there's a real opportunity for change. I think there's something psychologically weird about a lot of accountants where we're just very stuck in the mud about how things should be done. And, well, I've always done it this way, or, wanting to have that kind of an attitude versus, oh, this is actually a really core component of every business. And it kind of feels like my industry is asleep at the wheel. Like, I think there's a lot of things that we can do better. And at the same time, it's like accountants used to be the doctors of business, but that was like back in the industrial age. And business has moved on. And I feel like a lot of accountants haven't kept up with that and just are not interested. They just want to fill out the forms and tick the boxes. And they're not interested in what business actually could be, a lot of them. And so it just ends up making them much weaker advisors for business owners because they're not coming to just the financial advice from that perspective. They're giving really short-sighted advice, or, oh, you have to do this because it'll trigger a $200 penalty. It's like, well, who cares? Like, pay the $200 penalty, have use of the cash. Like, that's the better choice. But they don't see things like that.
It's almost like game theory, right? It's like, okay, well, yeah, right, like a $200 decision or a loss is on paper like really dumb. Like, Dave Ramsey would be like beating somebody into the ground and telling them that they're just burning up cash. But the reality, though, is, right, there'd just be some like shame fest. But the reality is there also could be a situation where what seems outrageous, like swallowing a penalty, could be you're deploying your cash to, again, I'll use the hiring another advisor scenario. What if that leads to $50,000 of excess revenue for you that year? Yeah. Right? And these are not exaggerations. These are real types of situations that I'm sure you've come across. The 200, it's because it's a penalty. This is why game theory is helpful. When it's a penalty, it psychologically changes the way you think about it. And really, we're not thinking about it properly, which is, again, is why I was super excited to have you on, Catherine, is not a lot of accountants think that way. I'm going to slightly change the subject, and then I want to come back to entrepreneurship. AI is going to really affect your world, by the way, and I'm sure you're fully aware of that. For the CPAs that are a little bit more medieval in their mindset, right, where they're just sort of checking the box, I think particularly machine learning and therefore AI is going to probably do that function at some point. But I really doubt, at least any time in the near future, that AI is going to have the capacity to provide that more nuanced depth to planning the way you can do it. So what are your thoughts on that? I mean, I feel like you're getting ahead of the curve on this, but do you think that this could affect old school ways of doing accounting because a machine can do it for you soon?
Oh, yeah. Well, and we saw it recently. One of the big four firms laid off 1,300 people. I think it's coming, and I'm so excited for it. I always say to other CPAs that I talk to, it's like, I'm so glad to be a CPA in 2024. Like, this is going to be so much fun. And one of the things I like about being in a smaller sized firm like I am, though, we want to grow over time, is the fact that we're nimble to deploy new technology. It's like I use ChatGPT all the time. Like, I use tax research software that's AI based now, and it's so much fun. And so I think if you can have that mindset of like, great, I can use this software to be able to offboard the lower level tasks that we're working with and use it to augment my ability to provide advice. Because one of the things that's really nice that I feel bad for you guys that you're always having to deal with is we don't really have a ton of regulation on us in terms of how we can deploy software and things like that. Like, we have a decent amount in terms of like data security and things like that. But like in marketing, like, we just don't have nearly the amount of regulation that you guys have in how we operate our businesses. Even though the whole operation is like getting people into compliance with the government. I'm really looking forward to all these AI tools being deployed and us getting to use it. And I think I think it will really change the industry, and hopefully for the better, because something that we're encountering as a huge problem is that there's a massive labor shortage. And we're going to start seeing it get really, really bad. Cause like for instance, the AI CPA, which is the main body that governs us, 75% of members were eligible for retirement back in 2020. So we're about to have like a silver tsunami of like people dropping out of the accounting industry. So the only way I think we're going to be able to make up the difference is through AI, which is fine because it does a good job. It's fun.
So there's a similar trajectory, and I don't know the exact math, but there's a similar problem in my business where the average age of an advisor is much, much older, and many of them are looking to sell their practices and get out of the business, which is another great reason that if you're not an independent advisor, you might be missing out on extraordinary opportunities to acquire other books, to expand your business in a powerful way. It's very difficult to do that under a W-2 model. It's a lot easier if you are either at an RIA or you're a part of an independent broker-dealer like mine, like Raymond James, where you have greater flexibility. But to your point, Catherine, there's going to be a mammoth shift in both of our industries because so many people are older. And it's funny. A lot of people will say, "Do you ever worry, Drew, that your field will be obsolete?" And I have the opposite concern. The concern is that fewer and fewer investors will actually receive advice because there won't be enough of us. And we're going to be in a position where we can be much choosier about the types of people that we can bring on. And so I think a lot of people could get completely boxed out of the wealth management world more so than they are now because there won't be the manpower. But that's where AI could solve a lot of our problems. If we can take care of some parts of the business tasks by deploying AI, then that could allow us to maybe service a few more clients. So, per advisor, it's just an interesting time, and I think it's a really wonderful time to be in. I think the finance world altogether, whether you're an advisor or you're a CPA. All right, I promise we talk more about entrepreneurship for the last 15 minutes. I've asked multiple people that are very successful, like yourself, Catherine. What would you say are one or two or three qualities that you think are essential for being an entrepreneur? And let me phrase it another way. When you meet successful entrepreneurs, what are some quality traits you tend to see in them or yourself?
Yeah, I would say the top traits that I see, you have to have a willingness to put in effort without seeing immediate return. You have to have control over your impulses. You have to have a humility of willing to learn from other people. And I put a grain of salt on that one just because I would say like 90% of the advice that I get from other people is garbage, like or has been in my journey. And so like that, like taking advice from people who have achieved the specific thing that you're trying to achieve in the context of that situation, like is really good. And I would say those are probably some of the core things of like being able to learn, like having a constant desire for knowledge, being willing to self-educate. And part of that is having the humility to implement changes and not think you know everything, because that's where it comes from. And then another one that I see really people, when they'll get through the first leg of that. And I especially see this in clients where they start to get hamstrung is the ruthless doing the return on time math and them not willing to let go of tasks and still trying to DIY certain things. Like I'll see people do that and then it sucks up all their time. And so they can't leverage their time to get themselves to the next level. I see people do that one a lot.
I do too. That strikes a chord with me because that is the biggest hang up I see, particularly with advisors. Well, I can do that. Like why I'll be a penny wise and a pound foolish. Like that's so typical where there's this sense. I remember knowing someone that they called all their clients. They didn't let their administrative assistant call the clients to sit the meetings. They called the client. I'm like, you have an administrative assistant that's literally bored half of the time, and they're telling me this. Why won't you just let her do her job? And you'll have more time to prospect. So I agree. I think the DIY mindset is actually a bit cancerous to business. If you want your business to stagnate, like treat it like it's Home Depot because it will indeed stagnate. You have to start to think, and that's the way culturally we're wired right now, Catherine. It's like, why hire a professional to do it when you can save money? But in the long run, you might save money, but you're losing revenue. That's, I think, what's so frustrating. The other thing when it comes to entrepreneurship is there also has to be like a willingness to be embarrassed. I think there's moments, I don't know how you feel.
Yes.
Like there's times where I'm like, I'll be honest, I can feel a bit like a fraud. Like, what am I doing here? Why am I doing this on my own now? You know, I've experienced a little bit of ridicule. People will think you're a fool if you leave the big firm, and they'll think you're a clown if you don't follow sort of the masses, and you have to have this level of grit and tenacity to sort of block it out. I heard a great entrepreneur say, like, a young man asked this person, he's like, what do you think is what advice would you give to me as a young professional? And he said, see where all the masses are going, figure out what they're doing wrong, and chart a brand new course with the thing that they're doing wrong that you're not going to do wrong. What are your thoughts on the willingness to be embarrassed and sort of grit and tenacity?
Oh, yeah. You just have to be ready to eat a lot of humble pie. Because I think when you go out and you're starting something and doing something, you will never be certain of the right answer when you're trying to make decisions. And most of the time you're going to make the wrong call because you just don't even have the perspective to see what needs to happen. I think something that's really important is having really solid business coaching for whatever it is you're trying to do, and being really specific about who you let into that relationship and making sure it's somebody who's done exactly what you're trying to do. Like they have done the thing themselves and are the kind of person that you want to be. And you take that advice to get you to the path to where they are. And then once you get to where they are, then you need to find the next person. But yeah, you just have to be willing to fail and not be afraid of that's just the cost. It's like working out or anything that's tough, right? It's like learning how to ride a bike. Like you just have to know that the investment of learning how to ride a bike is a lot of like tumbles, and you're just going to fall. Put some like knee pads on or whatever by just separating your personal ego from your business ego. But yeah, you got to be ready for just getting a lot of sucker punches, because that's just the way it goes.
It is the way it goes. So you and I have talked. We're both religious people. How much does the thought of ethics or virtue or work as a virtue in and of itself, how much does that influence or impact the way you think about business?
Oh, 100%. Like, it's kind of goes into almost the same methodology that I think of, the taxes is the tail of the dog. And like the dog is, the business of, the dog is your companion to you or something like that. It's like, you have to have it's like having a spine out of alignment. Like if you don't have those higher level things in order of like, why are you doing what you're doing? What is the purpose of life? What's the purpose of your life? Like, what are you supposed to be doing? If you don't have those things in alignment, like all the rest of the stuff is a waste of your time, like until you figure those things out. And so I think for me, a really big piece of that is you need to have the personal virtue, like what's going to be the capacity, the limiting factor in you growing your business and being a good entrepreneur is going to stem right back to what the personal issues are that you have in your life and what your personal vices are. Like that's what's going to trip you up. And I've seen that, like years of working with clients in different situations and different things. And you can just tell that it's always you. Like you're always going to be the one that's limiting things. And so if you don't see the focus of your business life and your personal life and your spiritual life and your mental life and your psychological life, if it's not all aligned up into a greater, energy channel of virtue and seeking to be connected to, for me, I'm Christian. And so it's, God and Jesus and that connection. But for people who aren't from that faith, I've met other people from different faiths who do have that same connection of everything is oriented up to that higher point, and it just pulls everything up. And I think in the business world, like it's just good business practice to be like that. But it's just you as a person, like, what are you even doing? Like, we only live for 100 years. Like, if you're just wasting your time on these daily activities, but it doesn't have any kind of deeper meaning beyond just some like material benefit, like why? Like why?
There's like a business nihilism that I see,
Yeah.
and I see it a lot in my industry and in the world of Wall Street, where instead of thinking of it in a deeper philosophical, in pursuit of logos, it's this like, I'll make more money and I get to drive like, I don't know, a G-Wagon, and I'll join this private club. And I'll play more golf. And I'm a golfer, so I'm picking on my own people here. But at a certain point, I think there can be an emptiness to like the life experience to begin with. And I saw a lot of emptiness, before I became independent, of like there's just sort of this constant pursuit of more money to go do. They don't even know what they want to do with their money half of the time. Yeah. And so to my point, it becomes very nihilistic. And what I love to see in entrepreneurs is this more of a core of virtue of why is business good to begin with, right? Like, first of all, is business inherently a good thing? I would say yes, because it employs people. I would say it gives them an income. You provide value to the end consumer. So the producer and the consumer, the labor and the consumer, like both of those parties are benefiting in this positive sum game called the economy. Usually it is, at least. And then furthermore, there's a psychological component of just having a sense of purpose. Like I was reading an article by Jordan Peterson over the weekend, and there's just this explosion of depression across our society. And interestingly, one of the things that he diagnosed is that the way forward for most people is finding some sort of sense of purpose. And what I like about business is, for those of you that might struggle with depression, business is a really good way to give your life a really good sense of meaning. And business doesn't need to be nihilistic either. It doesn't need to be like, I'm going to buy another Porsche and go to the golf club more or go on fancy vacations. It could be that you have this sense of duty to employ other people. Like, think of the virtuous cycle there is. Like, we talked a lot today about taxes. Think of the virtuous cycle, Catherine, of like, you're supporting all these advisors out there that have practices. What if you enhanced what they did so that they could employ more people? That means more wages. That means more people going into retirement. That also means more clients being taken care of and more clients getting their goals met, and they're going into retirement and they're leaving endowments or money to charity when they pass on. See what I'm saying with this virtuous cycle? Isn't that a richer way to think about business than just acquiring more stuff? So Catherine, I think you heard most of what I just said. I know you're back online. I think there was some sort of satanic attack, as you put it, since the lines went down the moment that we started talking about virtue. But so You heard the main point that I was making. What are your thoughts on that?
Oh, I think that's absolutely true. It's part of why my company's name is Dominion. I really believe in that. If you have the calling to be an entrepreneur, it is the best challenge of your personal virtue, I think, of anything that you could of most things that you could probably do. It has you come head to head with your own vices in a way that I think being an employee just doesn't quite do unless you're in a really dynamic environment. It really forces you to come to grips with your own failings and weaknesses, I think, in a really special way. And beyond that, I think if you're the kind of person who has the capacity and calling to be an entrepreneur, then there is a kind of duty around being able to bring value into the world, specifically through the economic engine of being able to provide people systems in which they can operate and make their livings for customers who you're increasing their lives through the value that you provide. Specifically for financial advisors, it's you're bringing in financial well-being into other people, where if you just decided, hey, I'm not going to do this, like I'm just going to I'm going to make my money, I'm going to sell my practice, I'm going to check out and be done. It's like you've stopped providing that value into other people's lives. And so I think that if you don't have a business that really is like establishing that dominion and that stewardship, and that you see yourself as really just a steward of the skills that you're given, a steward of the employees that you have, a steward of the clients, a steward of the asset of the business that you're building, you're going to be in a dysfunctional relationship with those things, and you're not going to get the outcome that you want from it. You're not going to get the self-development that you want from it. And you're going to have like that lingering emptiness. Like I see some people online that have really successful businesses, really smart business people, business guru people, and then they have this nihilistic element about them. And you can just tell like they're doing all of these things to try to fill up this void, and they're like getting close to it. Like they get close to kind of the stewardship thing, because they are like, it's funny in business. I think if you want to be successful in business, you still have to mimic virtue, right? It's like you still have to like work hard. You still have to do all these things. Like you basically have to mimic virtue in order to be successful. Otherwise, if you're cheating and stealing, like you're going to end up in jail. Like, you can't get away with being vicious if you actually want to be successful, because it's just not how things work.
No one will want to work with you too. If you're this narcissistic madman, after a while, like there's plenty of competition in the labor market. People will just go elsewhere. So there's a labor shortage. So good luck. I mean, people will just pack their bags and leave. You're right. There's the markets to an extent demand a level of virtue, whether the person wants to act virtuously or not. Okay. So the other thing, Catherine, that I've been thinking about is sort of as a marker of purpose behind a business is I've been thinking, and about a year ago, I spent a little bit of time reading a little bit of Aristotle and sort of his conception of virtue. And virtue, according to Aristotle, which was wrestled with, by the way, with a lot of Christian thinkers like Thomas Aquinas as well. Thomas Aquinas, to my understanding, sort of took the ideas of Aristotelian virtue and sort of made it square with the Holy Scriptures. That said, what I appreciated about Aristotle, and I think there's a lot of truth to this, is that if one of the ways in which you know that an action is virtuous is it should lead to a level of human flourishing. And so a deeper way to think about business is, are my clients flourishing as human beings? Are my employees flourishing? And if they're not, it may not necessarily be because I'm a bad boss, but do I care enough to be engaged in their lives to help them improve as individuals? And so I think another way in which, and by the way, I think there's a downstream sort of psychological impact that exists for a business. Like if you can pursue a business with a mindset of an Aristotelian virtue of human flourishing, there's a fulfillment that I've been seeking in my own personal life that I'm starting to find by trying to live a life that leads to a level of flourishing for myself and for those around me. How do you feel about that? Am I off base on this one?
Oh, it's funny. It's like one of the core. So in my firm, we have a couple of core values, and human flourishing is one of them. So
no kidding. Love it.
Yeah, no, because I think it's just, you're absolutely right. It's like, if you can point to that, are my clients better 6 months than they were before? Are my employees 6 months better now than they were before? And really on like that deep human level, like when I do one-to-ones with employees, like one of the big questions is like, where do you want to be 5 years from now? Like health goals, money goals, personal goals, all of it. Like where are you going as an individual? And how do I structure what we're doing in the company to make that happen? Like, how do I make your dream come true? And that really comes from a place of that you're not just trying to, and like I was saying at the beginning, you're not just arbitraging on people. You're not like, they're not pieces on the chessboard. You're not just plugging an hour in, getting $1 out. These are people that if you can really, and your customers are the same way, if you can really be invested in their long-term success with your benefit from the transaction kind of taken out of the math, what would that look like? And having that be a focus of how you structure things and really paying attention to that. I think it's essential.
I totally agree. Catherine, this has been a really fun discussion. I've enjoyed hearing about you and your practice. If you're an advisor and you're out there and you're looking for a CPA, look no further than Catherine. We'll put information out about you. But I thoroughly enjoyed our conversation, and thanks for taking all this time to chat with me today.
Yeah, thank you so much, Drew. I really appreciate it and the kind words, and thanks for having me on. Wonderful conversation.
Awesome. If you've enjoyed this content and you're looking for a wealth advisor, or if you're a financial advisor and you're looking to make the jump to the independent side, please message me on LinkedIn, or you can email me at drew.benson@bensonwealthmgt.com, or lastly, you can call my office at 603-316-2544. Securities offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Benson Wealth Management and True North Wealth Management Group are not registered broker-dealers, and they are independent of Raymond James Financial Services. The foregoing information has been obtained from sources considered to be reliable, but we do not guarantee that it is accurate or complete. It is not a statement of all available data necessary for making an investment decision, and it does not constitute a recommendation. Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. There is no guarantee that these statements, opinions, or forecasts provided herein will prove to be correct. Investing involves risks, and you may incur a profit or loss regardless of strategy selected.